Hello, everyone. We're going to study about the efficiency ratios. The efficiency ratios tells us how well the resources of the business are being used to generate revenue. That means how well you are using your business resources to generate revenue. The first efficiency ratio is your non-current asset turnover ratio. Non-current asset turnover ratio tells you how you are using your non-current asset to generate revenue. So your net book value of the non-current assets will be here at the denominator. So how efficiently you're using your non-current assets to generate revenue. So revenue will be on the top. How efficiently you are using your non-current assets to generate revenue, and whatever answer you will get is in times. So this ratio is expressed in times, and the greater times you are using your non-current assets, the better. That means the larger number shows that you are using your non-current assets more fully, more efficiently, and the business is using its resources to the best to generate net revenue. When I am talking about resources, we are actually talking about the net book value of the non-current assets. But we should note over here that this ratio can be very misleading if you don't take care to examine whether these non-current assets are owned by the business or the business is renting the non-current asset or the business takes the non-current asset on lease. Let's go with two examples. Suppose you have two companies. One is company A and the other is company B. Revenue that is generated by company A is 40,000. Revenue generated by company B is the same. But the non-current assets that we have for company A is 10,000 and company B is 2,000. If I take the non-current asset turnover ratio, that means the revenue divided by the non-current assets, I get the non-current asset turnover ratio as 4 times and over here as 20 times. So this figure gives an impression that company B is making better use of the resources, where in fact they are both operating at the same level. When I'm saying both are operating at the same level, both the company is generating the same revenue. However, company B is using less non-current assets to generate the same amount of revenue which company A generates by using 10,000. So your non-current asset turnover ratio tells you how efficiently you're using your non-current assets to generate the revenue. Okay? So the next efficiency ratio is inventory turnover ratio. If you want to find out your inventory turnover ratio in days, you will use the formula average inventory over cost of sales. Average inventory over cost of sales multiplied by 365. This will give you your inventory turnover ratio in days. This tells you how long, on an average, the business takes to sell its inventory. If you take a lot of days to sell your inventory, it means too much money is tied up in your stock. If too much money is tied up in your stock, it is an indication that you are having a slow moving inventory. This can harm your cash flow, and the cost of storage may also be high. If you have slow moving and it is not giving profits, then it should moving faster. So the inventory turnover ratio in days gives you an indication whether the inventory that you're having is a slow moving inventory or it is a fast moving inventory. You calculate inventory turnover ratio by using the formula average inventory over cost of sales multiplied by 365. Average inventory you get by opening plus closing divide by 2. And if nothing is mentioned, then closing inventory will become your average inventory. If you have a longer inventory turnover period, what does it indicate? If you are holding your inventory for more number of days, it means you have poor inventory management. Why do you have poor inventory management? Because too much stock is held. Average inventory period is a lot. Turnover period is more. Or maybe you are holding wrong inventory that is not selling. Okay, these are the reasons which lead to poor inventory management. A shorter turnover ratio or a shorter inventory turnover period implies good inventory management. So a business would want to know its inventory turnover ratio or the inventory turnover period to know whether they are managing their inventory well enough or not. Okay. If you have to find your rate of inventory turnover ratio in times, so it tells you how many times in a year your inventory is being sold. You just reverse the formula. You write cost of sale over average inventory and you get your answer in times. If it is in days, it is inventory over cost of sale into 365. The next efficiency ratio is your trade receivable turnover ratio. It tells you how long it is taking for your credit customers to pay you the money. It is given by the formula trade receivable over credit sales into 365. The next efficiency ratio is trade payable turnover ratio. It tells you how long it is taking for the company to pay its suppliers. So it will be trade payables over credit purchases. Okay. The purchases may be credit or cash. You need to read the question properly in order to find out whether the purchase that is given to you is cash purchase or credit purchase.